This episode is brought to you by Suzy, a cutting-edge market research software platform that empowers some of the biggest companies in the world, like Citibank and Procter & Gamble. To find out more about how Suzy can help you stay competitive, go to tearsheet.co/Suzy. Welcome to the Tearsheet podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller, and today we're examining the evolution of asset management and financial advisory services. And as technology transforms how we invest and manage wealth, we're exploring the critical balance between innovation and human expertise. We'll discuss how disruption in the advisory space creates new opportunities for clients and advisors alike, why personal relationships remain essential even as AI expands, and how progressive firms are reimagining compensation models. We'll also look at the hybrid approach resonating with next-gen clients who want both self-directed tools and personalized guidance. And joining me to explore these topics are Steve Woods, CEO and founder of Stirlingshire, and Jim Webb, VP of Investments. Their firm is working to revolutionize the asset management model for both clients and advisors. And today we'll hear about how their non-traditional approach to wealth management, how they're balancing technology with the human touch, and why this matters for both financial professionals and their clients. Steve, Jim, welcome to the Tearsheet podcast.
Thanks for having us.
So Steve, take us back. What's the genesis story around Stirlingshire? I think that's a good lead in to our conversation today.
Sure. So the origin story is basically I started in the industry as a 26-year-old intern with the GED. That in itself is a whole backstory, right? So I didn't necessarily start off at your Goldman Sachs or any of the high-flying bulge bracket banks, and so I kind of started in a smaller boutique and that side of the industry, pounding the phone, $500 a day type situation, and through my experience of starting at a place like I did, I got to see a lot of the nefarious side of the industry, right? And so as I progressed, and I kind of had to start where I had to start, right? As I progressed and became a decently successful advisor, I just always kept thinking about how do we make this better? How do we make this better? And I thought, the big guys must be doing something that we're not, and to an extent. Yes and no, because at the end of the day, what a lot of those folks are doing is they're closet indexing, right? And they're kind of trying to stay around the market. And their number one goal in life is just don't lose a client, right? As long as you don't lose a client, and when the market does great, you can say, oh, I'm doing so great. And when the market does bad, you can say, oh, it's the market's fault. And the entire time what they're doing is they're basically skimming 1% of their clients' assets off the top of their, accounts every year. So I really just thought, how do we make this better for everybody? How do I improve this for advisors, and how do I improve this for clients? That's kind of the genesis. And then along the way, there was, a couple big events such as COVID that kind of really gave me the ability to, if we're going to go forward with it, we got to do it right now. So that's how it all started.
Well, let me ask also, from I guess let's call it an investment model. And Jim, I'd be curious to hear what you say about this as well. Is closet indexing such a terrible thing? It does keep people from making worse mistakes. I guess it's a low bar, right?
Well, yeah, it's an extremely low bar, and realistically, where's the value add? So if your better advisors are truly advocates for their clients, and they're truly trying to do better, not just keep clients. I was in the union space for many years, and that was a lot of it was just basically don't do worse than the index. And retain your book. But for your average investor, I think you need to do better. And certainly just the whole idea of being net above the index after charging your 1% is a challenge enough for a lot of folks.
I hear that. And is that a product of, I guess, maybe the history of the industry? A lot of early FAs were ex-brokers, and It felt like a lot of advisory work was sales driven, sales led, and models probably took a backseat to, I guess, the customer acquisition process.
Well, it certainly was for myself. I came in a more traditional channel. I was started at Merrill Lynch in 1979, and basically what seemed to be really cool thing to be able to deal with investments when I went in the training door. When I exited it out of New York about 6 months later was I've become a really good salesman of financial instruments. And I was 25 years old, and that didn't seem like that was going to be where wasn't where I wanted to be. So I went in immediately into organized gambling, which was at that time trying to turn a dollar into $10 using just strictly option purchasing. And being in Hawaii at the time, 8.5 times out of 10 people lose all their money. And that's the great thing is say with options, you can only lose 100% of what you invested. So, and that was, a selling point. Well, for the Chinese and young military that wanted to do that, and the 2 times or 1.5 times out of that they might make $10 was enough of the thrill. So again, at 25, I wanted to latch onto something different. So I called it organized gambling because it was very organized and it was much, much like gambling. But from there, you morph into better ways of being the house, being on the other side of the trade and actually turning it into an investment strategy as opposed to just straight speculation. But yeah, that was the origin story for virtually everybody of a certain age coming into the advisory space.
And where's the change coming from? Meaning, we've done on the Tear Sheet podcast, we've covered a lot of the early robo-advisors from the earliest days. That seemed to take some of that, margin out of the business. But, I think they were very open about, well, I don't know if they were very open about it, but they were also closet indexers as well, right? In some cases recreating, the S&P. But I think like the move to ETFs, the move to a robo-advisory, I think fomented it in the investment customer base, the desire to like, hey, you're overpaying for a lot of like basic core services here, right? So, Steve, like, where does that leave an advisor then at that point? Meaning, that puts some downward pressure on pricing, right? And so how did you, I guess, in your career and in building Stirlingshire, how are you thinking about like ensuring that the FAs can fight against the compression spread?
Sure. So as far as the compression spread, right? We think of first and foremost we think that there can be compression if the total net take home of the percentage that's being charged is actually greater to the advisor. That's how we fight back against it, right? So they could, with Stirlingshire, they keep 100% of all their asset management fees and commissions, like across the board. There's zero cost to the advisor whatsoever. So this means somebody coming out of JP Morgan, who's probably on roughly a 35% payout, right? They can take their book. They're charging 1% at JP Morgan or whatever it is. They can take their book and they can compress that down to 85 basis points or 75 or whatever. And now they keep the full 100% of that. So that comes out much better for the clients, paying less, much better for the advisor taking home a greater share. And that's the legacy clients, right? Those are the clients that they bring with them. Things get a little bit different. The entire model changes whenever we think about the inbound clients, which are the clients that sign up via the app and sign up via the website, who we give to the advisors. Now, instead of a asset management fee of 1% or 75 basis points or whatever it is, now there's zero AUM fee. Now there's just a fee, just a commission on the sell side whenever we're actually booking them profits on ideas that we brought to them. So that's how we kind of fight back against the compression. We just get rid of it entirely. And then we'll get into that side of the business here a little bit later, I'm sure.
The financial industry depends on data, but not all data is created equal. Choosing partners who can separate fleeting trends from groundbreaking innovations is more crucial than ever. If you want to unearth what forces are shaping the industry right now, download our guide at tearsheet.co/Susie. Yeah, I think it's a good time to double click on the business itself. Can you take us through both the FA side as well as the consumer side, and the role that Stirlingshire plays in on both.
Sure. So first and foremost, I came from the advisor side.
Mm-hmm.
I was a decent producer doing a couple $1 million a year in production, and I just couldn't understand why I was paying $500,000 to go to work whenever I was doing all the asset allocation, all the client acquisition, and things like that. So I did a deep dive into the model, and I realized a couple things quickly that I didn't know previously. Number one, they weren't just keeping $500,000 of my front end, which is my asset management fees and commissions. They're also making about another $500,000 on the back end through margin interest, the sweep program, and fully paid stock lending. So at this time, I realized, I'm a decent producer. I'm keeping 1.5. They're keeping $1 million. Like there's some disconnect there for what I'm actually receiving from my firm. So I realized that we could build systems that allow us to kind of automate a lot of the compliance processes and build a lot of the compliance infrastructure directly into the code itself. Then it could help us do a couple things. Number one, it can help us move everybody to a permanent remote environment, right? So we can get rid of the real estate footprint. It can help us stop a lot of bad things from happening before they happen, which means we don't need to set aside as much money to deal with problems, and we can have less compliance officers on staff, which means less overhead. So basically, I came at this thinking, how do I get to keep every single penny in asset management fees that I generate, right? That was my initial thought. So, we built technology that allows us to do just that. Every single advisor keeps every penny that they generate in asset management fees and commissions. There's zero expenses to them whatsoever. And so that's how I began to think about it. And then I thought, that just makes the things better for me. Like, how do we make things better for clients in general? Because, building a business that has thousands and thousands of advisors bringing their clients on board, yes, that's $1 billion business, right? It's $1 billion market cap business. But you're not going to get to the tens of, or even $100 billion market cap by just doing that, right? You're going to get there by how do you structurally improve the actual asset management for clients. And how we do that is like just dismantling it in general. So instead of just coming in and just paying 1% a year across your assets, yes, we do that. We can fully manage that. But whenever we think about the younger clients who are going to be signing up, 30 years old, starting to make a lot more money in their career, maybe inherit some money. If I inherit $1 million today, I have two options, basically. Option number one, do I put it at Morgan Stanley, Merrill Lynch, pay 1% a year, whether it's up, down, or sideways? Option number two, do I fire it into my Robinhood or Webull account and trade it myself, or use one of their robo-advisors and pay 0.5% or 0.25% or whatever it is, right? We do both of those things, by the way, right? We do both of those things very well. But what we do that everybody else doesn't is that third model, which is in the middle, right? This is professional advice on demand, right? So you can put your money into Stirlingshire. You can self-direct at zero commission like the other self-directed firms. The differentiator is every single one of those clients is allocated out to a real professional like Jim, right? And most of the time they're not going to use Jim, but they can call Jim up and they can say, Jim, I have $100,000 in cash here. What do you think I should do? Jim says, I think you should do X, Y, and Z, right? He gives them a hyper-personalized recommendation specifically for that person. Person looks at it, hits the confirm button, which routes the trade out to the market makers. Now, that advice hasn't cost the client anything at all, right? They're not paying Jim for that advice. The only time they actually pay anything is in the future when they sell that specific position for a profit. There's a small commission on the sell side, which Jim actually keeps 100% of, right? And so what this has allowed us to do, this has allowed us to build technology that allows us to offer high-level, personalized professional advice from licensed individuals in an on-demand basis and tie the compensation that's being paid directly to the outcome of the specific advice that's being given. So rather than paying 1% of their entire portfolio or 0.25%, they might pay 1% whenever selling a position that the advisor told them, hey, I think you should buy this, right? So that's what we do that's a little bit different and lowers the overall cost to the clients, and while allowing them the flexibility to self-direct. And then listen, if they get to a point where they say, I don't want to do anything, Jim, Jim, just do it, right? Then Jim can, move everything to the fully managed side. And then, we have 120 different firms piped in, BlackRock, JP Morgan, all sorts of other firms where we can use models that they've built. So either Jim can you know, build models himself, or you can outsource to some of the best and brightest in the business, and kind of giving everyone the ability to operate within the regulatory framework that FINRA and the SEC have laid out, and just kind of operate their business from a client or from an advisor's standpoint, any way that they see fit.
One of the things that's interesting in that in-between model, Steve, as you were saying, is the advice that Jim would give on that specific transaction kind of ties in, like, obviously profit seeking and maybe longer term than shorter term. I'm also kind of curious, have you been around long enough to see sort of a graduation of clients coming in, maybe that self-managed or that hybrid model that you're describing, and then eventually, saying, well, Jim's advice has been spot on, the past, 2 years or whatever. I want to give him more of my book to manage.
Sure. What we've seen, right? We're obviously a startup. Right? We're 1 year, 16 months out of stealth now, right? Phase one of the company was, hey, let me get everything set up. Let me get 40, 50 advisors in the platform. And then we're going to go out to the world and start marketing for the inbound clients, because at the end of the day, I couldn't start driving inbound clients into the platform and offering advice on demand if I didn't have that supply of advice. So really right now, we're just now starting to turn that corner to go out and start, driving clients into the platform, because without the advisors in the platform, then we're just another E-Trade, right? And we're never going to beat them at that business. So that's kind of where we're at right now, where we're beginning to go out and let the world know that this exists. Previously, it was letting the world know that, hey, we can pay you more than every other firm in the industry. And now it's, hey, we have this new model. Come check it out. We think you're going to love it.
Right. So you had that cold start model, and you populated first with the advisors. I'm curious in terms of the pitch to them, is there also an excitement about your ability, maybe yet unproven, to bring them new clients in the future? What's the original? The original hook is a larger payout, right? Like that seems a very simple pitch.
Yeah, the original pitch is, here, we're going to pay. You run your business like you always do. We're going to pay you more, give you the flexibility to work wherever you want. And now it's becoming, now people within the industry kind of are beginning to understand that. They're beginning to seek us out, which is great.
That's awesome.
That's why we'll start spinning. Now the pitch is becoming, hey, in addition to all of this, we're going to help you get clients as well. Because Jim can tell you, the hardest thing in the entire industry to do is to get a client, right? Once you have the client, then everything else is kind of a little bit easier. That's, a lot of times people's number one struggle in the industry is actually gaining clients. So if we can solve for how do we get clients for advisors and couple that with, here, I'm going to pay you more, then the flywheel really begins spinning from both directions. And then obviously clients begin going out to their friends and saying, hey, I have this service at Stirlingshire where, I'm only paying my guy if he actually makes me money, right?
I don't think we've had guests on this podcast over the past, it's called 14 months that we haven't spoken about AI. And I'm kind of curious. I bumped into a friend the other day, and he was using like ChatGPT almost as a therapist. And it got me thinking, you could be asking ChatGPT for investment advice as well. I don't know if it gives it at this point, but I'm kind of curious on your both of your views on the role of AI right now, and I think maybe where you see it heading.
Sure. So I'm going to let Jim talk about this, because Jim is actually he's one of the few advisors that have been testing out our AI tools. Maybe he can talk about his experience using them so far. So we have them, and they're coming down the pipeline pretty quickly.
So I think realistically, for your better advisors are advocates for their clients. And just to backtrack a little bit here in terms of the appeal of Stirlingshire and what grabbed me. Sure, 100% payout's great. I was on a 90% payout in my prior firm, and I was at a firm that had a unique model that about 20% of us were limited partners of the firm. So was frankly not looking particularly for a change. But what grabbed me in the Stirlingshire approach, beyond a little higher payout, secondarily is most advisors, particularly old dogs like myself, hate to be nickeled and dime on admin fees and insurance and all these things. And Steve's model basically means that we don't start out each month $1,500 in the hole just on fixed fees or fixed costs. So that was an appeal. But the big hook for me was a lot of, in the traditional brokerage channel, basically you were an employee and the client was owned by the firm, you were owned by the firm, and except you were on the same side as the firm in most of the transactions versus the same side as the client, because you both were playing this game of don't do anything that will cause any pain, i.e., litigation or something of that nature. So you sold the approved products and all those things. Then you go into the independent space and you no longer have the employee model, but more and more independents were starting to gravitate towards the old traditional wirehouse approach of risk management wasn't risk to the client, it was risk to the firm. So bottom line is, I'm sorry, I had a phone call come in. Bottom line was that you were no longer an advocate for the client. Stephen's approach immediately resonated with me that I would be able to use a unique model that I have in a manner that with instruments that were somewhat new, that some of the independent firms were looking at and going, well, we're not sure about the suitability. So if we're not sure about it, we'll just kick it out. And there's a lot of new things that have come out in the last 2 to 3 years that are income generating, that are just blow people away relative to what was available. So bottom line is, I think some of those things are certainly available because of AI. AI in the sense from a user standpoint, such as myself, is a great screening tool to basically do some of the early math and eliminate some of the players so that you can get down and apply your expertise to a much smaller number. Secondarily, the AI that Stephen's brought into place for me and a few others in our beta test here is to allow us to just pull out what's going on today, what happened right now type of information, that we can do it in a contemporaneous manner and, quite frankly, sound like we know what's going on at times. And that's critical. If you're managing somebody's money, you need to have a sense that, listen, don't stay away from the ledge. I've got this. This has happened before. It's a little easier for me after 46 years to get away with that, but from the younger people, not so much. And the AI tool is a robust database that is attached to all things going on in the marketplace and attaches to the actual client's account as well. So it says, and this is affecting you because of X, Y, Z. The idea of AI saying, hey, AI, build me a portfolio. No, that's not there yet. And there are just too many variables, frankly, for that to survive litigation in the long term, in my opinion. So that's the practical use.
Until the SEC and FINRA really lay out guidelines for how AI can be used to make recommendations, because at the end of the day, each individual IAR and firm has the responsibility for the recommendations that are being made. And so until we understand really the framework of, the computer says this, and here's how a human says, okay, this is actually good, we're limiting it it's not actually making trades and doing things for us. For example, you can say, tell me about Mr. Jones's portfolio over the last quarter. What happened, right? And what would you suggest in order to reduce risk and increase return? And it'll, in 3 seconds, be able to spit you out a really detailed breakdown of what happened, and so forth, and really just makes the advisor's work much more efficient. So instead of taking 20 or 30 minutes to break all this down, it does it in seconds for you. And that's what we're using AI to do, is work a lot quicker. And, obviously the advisor needs to look at what the system is presenting and make sure it's not hallucinating and not coming up with some crazy stuff. Right? But then we will eventually get to, a situation where we have the capability to, utilize it a little bit further in the process. That's what we're doing right now, is we're making everybody quicker and more efficient.
So the pitch to the FA, you're making it quicker, it's more efficient, you've got a larger payout. It's getting easier and more profitable, I guess, to leave and go independent. Maybe we could talk about, like, your success actually makes retention. I'm aware that it makes retention harder, I guess, at existing firms. So Like, what are some of the things, what is the role of talent in this market where we're talking about like technology enabled advisors? Like where it's becoming increasingly easier to leave, like how do firms think about, holding on to their top talent? What role does talent play in this market?
So I don't know what everybody else is thinking about retention. I am a broker protocol firm, right? So they're able to leave with their clients anytime they want for any reason at any given time, right? So how I think about retention is we need to build a better product than everybody else. And if we do, we're going to be able to retain and attract top quality talent. And if we don't, then we're going to lose it, right? And that's my fault. So I'm not trying to prevent people from leaving. I'm trying to encourage them to come. And if I give all the tools necessary to operate their business, and I give them more money and I give them clients, if somebody can take them away from me, good. I might consider joining them too. That's what I think about it.
And your better advisors can sniff out pretty quickly whether or not this is going to be a black hole once they get there. The typical today you were a prospect, or yesterday you were a prospect, today you're a client type of wake up once you're there. And Stephen has been very transparent in terms of, look, if you think there's a better opportunity for you and your clients, you're really as a shepherd for them, you need to take that move. But if the focus is on allowing your advisors to be the best advocates that they can be for their clients, the economics take care of themselves. And so artificial things to keep people
right. And we're not building this to be the most profitable RIA in existence, right? We're not going to blow everybody's doors off with, our margins, right? At the end of the day, we're going to be towards the bottom, right? So this is a scale business, right? Our advisors cost a lot every single month, but my belief is if we're able to structurally change the asset management model for the better, then everybody who's involved in this is going to do very, very well. And at the end of the day, I think you can think about how Robinhood changed the discount broker dealer. You think about 12 years ago, everybody's paying $20 a trade. Robinhood came out and they said, we're going to charge $0. Everyone said, oh, that's kind of ludicrous. And then over the next 10 years, every single self-directed firm changed their model to, kind of do what Robinhood was doing. And that's our goal here, is to go after, listen, at the end of the day, we're never going to be able to drive JP Morgan, Morgan Stanley to 100% payout, right? The most beloved banker in the entire industry is Jamie Dimon. If he came out tomorrow and said the tens of billions of dollars in asset management fees that we keep from our FAs every year, we're going to let them keep that. Like, everyone loves him, but their dividends gone tomorrow. The company goes bankrupt. They can't service the debt on all the real estate, right? And then he gets frog marched out the front door. So we're never going to drive them to 100%. But if we can make that impact at the LPLs and the Mosaics and all these other firms, drive them up to a real 100% payout, and kind of bring that advice on demand model to the independent side of things, then I've done what I've set out to do, which is improve the world and the financial services world, and that's more important than making my next $1 billion, right? And if I'm able to do this if I'm able to be successful and drive the model forward, then the money is going to come.
You'll be able to spend more time with Jim in Hawaii. Yeah.
Yeah, there you go. I think there's been a couple of inflection points. Charles Schwab initiated into the industry, discount broker, Robinhood, and the impact they had. And frankly, AI is often thrown in there as the same thing. We've been doing portfolio optimization without AI for years and years and years. I don't think that's it. I think what Stephen is doing here, potentially, he may end up looking like Charles Schwab at some point.
Steve, I want to end. We have time for one last question. Just with a look forward for yourself, for Stirlingshire, for the industry. Like, what are some of your, or what is your biggest goal or goals for this upcoming year?
Yeah, so biggest goal for this year is, we hired 40 advisors last year. Our goal is to hire 260 more this year, so 300. Wow. So that's our goal for this year. we're laser focused on that. We're doing a Series A in order to begin to really ramp up that inbound client flow, right? So we got to get our message out. It sometimes costs a little bit of money to get out there and let the world know what exists, right? And so the Series A is important to help that. And then over the next 5 years, our goal is to hire 5,000 advisors over the next 5 years. So there's 620,000 or so in the industry, and that's we think a very feasible, very large but feasible goal. That there's probably that many people in the industry that want 100% payout and 100% flexibility and inbound clients, right? So if we can solve those, I don't think getting to 5,000 advisors is a problem.
Awesome. Well, best of luck with those ambitious goals. Jim, Steve, thanks for joining us on the Tear Sheet Podcast today.
Thank you so much.